We are in corporate financial management, and today we'll discuss the international aspects. That this is the last chapter of our syllabus, and within this chapter, that is chapter 8 or module 8, we have 5 topics. What is multinational operation? Then we'll discuss these topics: foreign investment decision, financing overseas investment, political risks and foreign exchange risks, management of exchange rate risks. So within this chapter, it is a totally theoretical chapter. So after a study of this chapter, we will understand multinational operation, foreign investment decision, financing overseas investment, political risks and foreign exchange risks, and how to manage the exchange rate risks. So if we see here the why companies go for multinational, is the help for economic of scale, that is greater efficiency but lower price. And within this, that means if we see here more research and development leading to the improved product, create job and wealth, that is a wealth around the world, success in inflation, then meet consumer reflection. And also it has some another point, that is sometimes company go for multinational for avoiding their tax. That means there is a scope for tax avoidance and loss of tax revenue by the government. So there is a problem for that within the country. For example, if you go for multinational, there are some lot of companies there for avoiding tax. That means government will lost their tax revenue, and monopoly power lead to the higher price for the consumer. Monopolistic power in the setting lower wages often have a negative impact on environment and a cultural problem also. So it is the problem for multinational, and good thing is that multinational is for increasing the efficiency, create the job, etc. So if we see here, international finance is an area of financial economics that deals with the monetary, that means international between two or more countries. And if we see here the international aspects, we have the there are some difficulties also. Is the foreign exchange risks also, political risks, expanded opportunity, etc. is the for the multinational aspects. So why political risks is we are fearing regarding political risks? Because if anyone invest another country, is go for the multinational also. So another country, for example, if we take a license for internet service providing and investing huge amount, if political unrest, government change, if a new government cancel the license, then the investment would be bad investment. For example, at this moment, we have the Grameenphone and other tele network, but also government have the teletalk network. If governments think that if teletalk will be only one mobile network, no license will be that means renewed. For example, Grameenphone and other, then Grameenphone investment would be a bad investment. So that type of problem can be happen in multinational also. So going multinational with a business has a number of consequences, both positive and negative impact. So here, why going foreign market? To gain access to new customer, to achieve lower cost through economics of scale, to further exploit the create a competence to spread business risks across the wider market, to gain access to the resource and capability located to foreign market, and motivate for going multinational. Why we go for multinational? Lower labor cost. If any company's labor cost is low, then there is a huge industry may establish. For example, in our country, we have the garments industry because of lower cost of labor. Because we know there is element of cost, three item: material, labor, and worker. And if the one item cost is less than other country, so our production cost be less. So if production cost less, then your margin would be high for profit margin. So that's why lower labor rate company countries, there we can establish the industry. So another reason: lower labor cost, lower other cost, exploiting national dimension, marketing advantage, scale of economics, integration and competition, expansion of product life cycle, tariff avoidance, and incentive of host economics, that was incentive. So that type of activity motivated to company going for multinational. A multinational business is one of that maintain division of multiple countries through the world. So that is multinational. Why we are saying multinational? Because in different nation, within the different nation, multinational. While each branch or division operates under a guidance of a central office, that means holding company, usually the company's nation of the origin, its division is subject to the law of the host nation. Business go multinational when there is a favorable situation available in which the profit generation, positive profit, and which could take the form of the new customer market, new consumer market, or a less cost production infrastructure, and sometimes both things. So that's why multinational business is increasing. That means peoples are very much interested for multinational in different reason. So what is the advantages of multinational operation? Conducting business of the multinational level bring with the host of benefit for the companies operating abroad, that is one country to another country. The most well-known advantage is the ability to tap into low-cost labor market, which represent one method of cutting production cost. So as we said that if production cost less, the profit margin would be high. And advantage and limitation of multinational companies here. What is the advantages? Advantage is that employment generation, automated inflow of foreign capital. For example, if another country's another company come to Bangladesh, that's FDI, foreign direct investment, that means they're bringing the money in our country, so as a foreign currency. So it's also advantages. And proper use of idle resource, improvement in balance of payment position, technical advantage can be happen, managerial development can be possible, find of local monopolistic, improvement in a standard of living, promotion of international brotherhood and culture. And what would be the disadvantage for the multinational? Disadvantage is danger for the domestic industry, because if multinational companies establish their business within, for example, within our country, so what product they are producing, and that type of product is locally a small company or a semi company produced, that company would be in danger, because foreign company, they would create the proper distribution channel and price of the product would be less. So that's why people or consumer will buy that product, not our local product. So after that, after few months or few years, our local company or industry will that means they cannot be able to run their business. So it's also a dangerous thing, and repetition of the profit, because foreign company, they transfer their profit and technical know-how expenses also to their own country, and no benefit to poor people, danger to independence. For example, in our this subcontinent, British ruled 200 years. So he also is the matter of independence, because that time East India Company came here for the business purpose. But once upon a time, they took our that was full independence within took there. So this disgraded to the national interest for the host country, misuse of might state, clearless expression of national resource, selfish promotion to align culture, exploitation of the people in a systematic manner. So that type of problem maybe happen after a multinational, but there is a huge of advantages also. Drawback, that is also is as a bad thing, that is ethical concern of our one of the biggest drawback
Sir,
conducting multinational.
explain the end of the monopolies. You explained earlier.
End of the monopolistic things is that because এরকমের যে মনে করেন আমাদের দেশে একটাই কোম্পানি, সে একটা প্রোডাক্ট আছে এবং সে হাই প্রাইস এটা বিক্রি করতেছে। এখন যেহেতু আপনার অল্টারনেটিভ প্রোডাক্ট নাই, সে কিন্তু একচেটিয়া ব্যবসা করে যাচ্ছে। যেহেতু প্রোডাক্ট নাই, এই জন্য তারটা সবাই বাধ্যতামূলকভাবে ব্যবহার করতেছে। যদি সেম প্রোডাক্ট অন্য একটা মাল্টিন্যাশনাল অন্য কোম্পানি এসে প্রডিউস শুরু করে, এবং তার তখন কস্ট কিন্তু কম পড়বে, তার প্রোডাকশন কস্ট কম হওয়ার ফলে সে কিন্তু একটা ফরেন কোম্পানি যখন কাজ করবে, ওর কিন্তু অনেক চিন্তা ভাবনা করে এস্টাবলিশ করে। সে কিন্তু তার প্রপার ডিস্ট্রিবিউশন চ্যানেল থাকবে, থাকবে। তখন কি করবে, তার প্রোডাক্টটা সারা দেশে ছড়াই দেবে, এবং প্রোডাক্টটার দাম দেখা যাবে গুণগত মান আমার এখানে যারা একচেটিয়া ব্যবসা করছিল, তার প্রোডাক্টের চেয়ে এটার গুণগত মান ভালো হবে, কারণ সে কিন্তু টেকনোলজিক্যাল জিনিস নিয়ে আসবে, টেকনিক্যাল নো হাউ তার কাছে আছে, এবং তার প্রোডাকশন কস্ট কম। সে দাম কমায় দিয়ে মার্কেটটা দখল করে ফেলবে। তখন কি হবে, এর ফলে কি হবে, উনি যে একচেটিয়া ব্যবসা করতেছিল মনোপলিস্টিক, ওইটা এখানে ধ্বংস হবে। এইটা বলছে ওইটা, এটা হচ্ছে ভালো দিক হিসেবে বলছে। আবার এটা উল্টা আছে হলো, আমাদের যে ছোট ছোট কোম্পানিগুলো সেগুলি ধ্বংস হয়ে যাবে যখন ফরেন কোম্পানি এসে তার প্রোডাক্টটা আমার দেশের ভিতরে চালু করবে, তখন আমাদের নিজস্ব যে অস্তিত্বটা বিলীন হয়ে যাবে। এরকম দুই সাইড, একটা হচ্ছে ওইটা যখন একচেটিয়া ভাবে এরকম আছে না, যে ওই জিনিসগুলাকে ওইটা হচ্ছে মনোপলিস্টিক। ঠিক আছে স্যার?
Thank you, sir.
Thank you. So then, drawback of multinational on host economy. What is drawback? Leakage from the economy, pieces and that means bargaining, price and bargaining power, etc. This includes host economy. That means, for example, and if any company come to our at this moment, government is giving different types of facility for FDI. And also, we have the special economic zone. Also, a few days ago, Bangladesh Bank circulated that if any foreign FDI come for establish the company, they can open their account, that means temporary account, foreign exchange account within the high-tech park, within the high-tech park area, within the economic zone area, etc. And outside the zone, they can open Taka account easily. So, and also in our country, we have different place also. Here, government is giving the tax facility, different types of incentive also. So that type of thing is happening. So by this way, if they establish their industry in our country, and one thing is positive, that our employment generation would be create the employee generation, and they will bring the FDI. Also, they will bring the technical know-how, and also sometimes they can. That means here saying that price and bargaining power. So that time, what would be happen? We know all price depend on demand and supply, based on demand and supply. So if you have the ability or facility for bargaining, how much price that means would be for that product, so that stage can be happen through multinational. And trade of local competition, power to pull out, encourage the dual development, resource grabbing, and labor explanation. Resource development, for example, that here, if any good technical person within this country, they can send that person to their country. Also, for example, in our country, there are a lot of projects going on. But if you calculate all projects, the consultancy fee, they're taking the consultancy fee through their people and sending that amount from the project to their country. If any FDI come to our country, it is the positive for our country, etc. So here, ensuring a positive net impact, it's the if foreign currency or multinational operation come, their net positive income will come here. And also foreign investment decision how company take. So foreign investment consists of a flow of capital from one nation or one country to another country in exchange of significant ownership, a stake in domestic company or other domestic asset. So it is the foreign investment consists of flow of capital from one country to another country. Foreign investment denote that foreigners takes a somewhat active role in management as a part of their investment. Foreign investment typically works both ways, especially between countries to relatively equal economic status. For example, in our country, we have DVDL, the BDBL, DVDL, the Dulal brothers. They also established the garments of Africa, and also some company they are going for the Nigeria, some are the Vietnam, etc. So it's a similar country. So foreign investment decision, how come? Example, firstly we have to assess the market, assess the environment, and the production needs, and need our commitment, and after that have to adopt that policy within that country. So is the foreign investment decision come this way. And impact of multinational capital budgeting, and we know the capital budgeting. What is the multinational capital budgeting? So multinational capital budgeting is that in a one umbrella within an umbrella, if you have different company in different country, so if you go for capital budgeting, it would be the multinational capital budgeting, and different currency, different environment, different situation. So that is the capital budgeting of multinational. So here they have to think what is that initial investment, price and consumer demand, what would be the cost, tax law, remitted fund, how much money can be remit from one country to another country, what would be the tax law, what would be the tax rate, exchange rate, and a salvage value problem. Also sometimes here they are depreciation issue. For example, different countries, they are giving the different types of depreciation facility. In initial stage, the accelerated depreciation allowed. Accelerated, that means 50% or 40%, 60% capital investment. They allowed for the depreciation. Is the benefit for the investor, because if you took 40, 60% expense in your profit and loss account, so your net income would be less, and tax have to pay less. So this is one kind of benefit also. So that type of benefits was countries giving. So for going multinational, that type thing also have to think and require rate of return. How much rate of return we need for investment, and international marketing strategy. How this fixed segmentation. What is segmentation? And different item, different product in different line, and positioning, research, marketing risks. And we know the marketing risks, there's a product, price, promotion, placement, etc. within the marketing risks. And effectively doing that type of work and think the multinational capital budgeting and go for the investment in there. So foreign investment trained to look at a number of factors relating to how they will be able to operate in a foreign country. The rules and regulation pertaining to the entity operation of the foreign investors. So there are types of rules and regulation, because if the host country give the facility, for example, if any foreign company come to Bangladesh, then we have the different types of tax law. They cannot send their total that means profit to their own country. So, and at this moment there are different types of flexibility also, and sometimes some restriction also. And for example, in EPZ area, foreign company, they must open their bank account in the foreign currency and all transaction with the foreign currency. And within the EPZ, the all product produced in the EPZ that should be export to the another country. Not they cannot sell their product within the country. So that type of restriction, rules, regulation is here, and a standard of treatment of foreign affiliation compared to nation of the host country. The fluctuating and efficiency of the local market, trade policy and privatization policy. We know we have the BIDA, Bangladesh Investment Development Authority. Previously it was BY and other two country parts, and now is the BIDA, the Prime Minister Office. So they are giving different types of facility. At this moment, 36 items within the BIDA's one-stop service, through bank account to company registration, everything all within the one-stop service. So that type of trade policy and privatization policies at this moment we have. And also we have the another thing, doing business. Day by day we are though our cost is huge and they also huge, but now government is trying to minimizing it. So that's why BIDA is working at this moment. And business facilitation measure such as investment promotion, incentive, improvement in attained, and other measures to reduce the cost of doing business. For example, some countries set a special export processing zone, that is our EPZ, which may be free customs or duty, or offer a special tax break in the new investor. And that type of facility or foreign investment train will be positive if the different types and different factor would be positive for the investor. And in the foreign investment decision, determine influence the choice of country. Which country you will choose for investment in foreign. So here some basic thing is that determination influencing the choice of country. How we will choose a country for investment, not within the country, other country. So countries endorsement, where population is huge, large population, there your product will be run smoothly, because if population huge, their consumer is huge. So they have to use it. the people who is use the product. That's why larger population country, if we choose that, it would be greater than, it is be better than other countries. And geographic location, natural resource where is huge, that country can be choose for the investment. Product, that means for marketing, distribution, everything within have to be positive, and where larger population, that product would be very much effective for the marketing also. So, and investment climate also, political stability. For example, in a company, at this moment, if you go for Somalia or for Sudan, South Sudan, you will not be able to invest there because they have political unrest. Also Nigeria also. And economic stability, ability of infrastructure, quality of labor. If there is no labor, qualitative labor, so how you will invest, that means establish the factory. So that type of item, that means investment climate, required for choose a country. And incentive scheme, example, tax exemption. And if you see that, if your total profit, if you got the profit, the 50 or 60% have to pay the tax, then you will not go for investment in that country, because need the tax exemption. Because that's why in our country, for interaction of the FDI, government or tax authority is giving that type of facility, tax facility, tax exemption facility, reduced rate tax, and zero tax also, and accelerated depreciation, what we say, and cash grant, tax holiday also, export processing zone, etc. is the incentive scheme. So if we see that, for finding a country where we will be able to invest, we have to see the country's large population, country's population structure, geographical structure, natural resource, investment climate, where include the political stability, economic stability, ability of infrastructure, quality of labor, and also we have to see the incentive schemes also, tax rules, tax law, tax exemption facility, accelerated depreciation issue, cash grant, government subsidiary also, tax holiday issue, and a specific zone where company can be established. So it is different types of factories here. And also foreign portfolio investment, the determination of foreign portfolio investment, earnings are most likely to be tied to the broader macroeconomic indicators of countries, such as overall market capitalization. Overall market capitalization of an economy. They can be more sensitive to factor high national economic growth rate, exchange rate stability, general economic stability, level of foreign exchange reserve held by the central bank, general health and foreign banking system, liquidity of a stock and bond market, interest rate, etc. Also the factor we have to think about the foreign portfolio investment. In addition, general economic indicator are the each of the repeating dividend and capital. That means if profit, we know the how dividend is declared after giving the tax from the net profit, the how much money left, that proportion is they give the, that means declare the dividend or paid the dividend, and out of the dividend, that means excess of the dividend, they're taking in the retain within the company. So if dividend declared or paid, the from this country's dividend can be sent to the easily to the parent company. So it's also, and capital also, and tax on capital gain, regulation of a stock and bond market, and efficient capital market, the quality of domestic accounting and disclosure system. And why the efficient capital market required? Because after establishing the company in foreign, in another country, and once upon a time, after establishing, they go for the listing, and after listing, the foreign investor can be sell their total share within the country, and they can bring their money to their home country. But companies establish, so that's why need the capital market, vibrant capital market, the quality of domestic accounting and disclosure system, the speed and reliability of dispute settlement system, the degree of potential of investor right, etc. So what are foreign investor looking for? One foreign investor, what is looking? Good project, demand potential, revenue potential, a stable policy, environment, political, and also the government commitment, and optimal risk allocation framework. Factors affecting foreign investment. Which factor affect? If we say shortly, rate of interest. What is rate of interest? For example, that company brings few amount as an FDI for establishing a company. For example, they want to go $100 million project. So they bring 30% amount. That means $30 million they bring to from their country to, for example, in our country. So 70% they have to take the money from the bank loan, because within this, that is your loan and equity. That means 70% loan they take for the establishing a company, 30% their equity. So here the interest rate is high. If high, then they cannot be survived, because they have to pay more interest expense than their expectation. But at this moment, we have 9% interest in our country. Government declare it. And also not only that, at this moment, there are few banks, they are giving only 7% interest for a good borrower, not the 9% also. So day by day, our interest is decreasing. And some factor another, speculation, profitability, cost of production, economic condition, government policy, and political factor. That type of factor can be thing for an investor for investing to another country. Financing overseas investment is all for today. Thank you.